Hello and welcome back to another episode. Today we have an update hot off the press about the Fed's decision to cut down rates, and it has been confirmed. They agree or they announce another rate cut of 0.25 basic points, which translates to another 0.25%. So depending on how you look at it, it could be great news if you have been waiting on the sidelines to buy real estate, to finally buy your dream home, or to just simply put that money to use and buy your first investment property or second or third. If you are a business owner, that also means great news because that means your business loans are going to be a lot more affordable, so to speak. And but however, it comes with this downside because it depends on the perception that or the message that the market might perceive from this move. But overall, the market is reacting very positively. We're gonna take a look at the rates now. They're all looking nice and beautiful. And same thing with the stock market. The stock market rallied after the announcement. So all great news, all great moves. So what I'm going to do now is to quickly share the update directly from CNBC so we can all just go through it and just check out the updates. I want to say in real time, but I mean, not quite. Let me just refresh just in case. So once again, hot off the press, divided Fed. Yes, not everyone agreed to lower the rates, but in the end, the outcome seems like it's working out for us, for those who have been waiting. And the Fed finally approves a third rate cut this year and sees a slower pace ahead. So what are the key points that we must pay attention to? Well, first, that the Federal Reserve split over its priorities, whether they should cut the interest rates or not. And finally, in a 9-3 vote, the announcement of a rate cut finally came out. But however, it seems like in future years the rate cut it's not going to be as frequent. I mean, that's what they said at the last meeting in October, and then look, I mean, we ended up with another rate cut. So the thing with the Fed is that sometimes that they can only act or give their projections based on the information that they have available at that point in time. But things do change, as you saw. A lot of things change. A lot of things came afloat. The jobs report came out, and now they have a much clearer picture, or at least that's what we like to think, about the market conditions, which eventually led to that rate cut. So the FOMC indicated that just one more reduction will happen in 2026 and then another one in 2027, given the disagreements amongst its member. And in addition to the rate decision, the Fed also announced that it will resume buying Treasury securities. And the central bank will start buying 40 billion in Treasury bills beginning this Friday. So just to give a little bit of context, so the Fed has a dual mandate, right? So they want to maximize employment, and they want to make sure they are able to maintain a healthy economy for everyone, and that the inflation is keep at the rate that they want, which is typically sitting at 2%, right? And so the way they, aside from that, one of the many actions that they take to stimulate the economy is through quantitative easing or tightening. So one, it's meant to inject money through the economy and just sort of like help it restart or get it going, for example. And that's what they meant by they're going to start buying Treasury securities again as a way to inject money into the economy and just get the ball rolling. The opposite happens when they just don't want to buy anything and they just stay out of it and let the market do its thing. So like I said at the beginning, depending on how you look at the scenario, it's great for those who have been waiting on the sidelines to get access to capital at a lower rate, but it also signals that the economy is weakening. And not that no one knew, like this year has been quite an interesting year, but one thing is to kind of like know it, but then waiting for confirmation, and then one thing is getting the actual confirmation, and that things, they just sit and they hit you a lot harder. But overall, like I said, the economy is reacting really well to it, so it's all great news. So now moving to the rest of the article, we have here that once again, a Federal Reserve split over where its priority should lie on terms of cuts, and fulfilling expectations of a Hawkins cut. The central bank FOMC lowered its key overnight borrowing rate by a quarter percentage point, putting it in a range between 3.5% to 3.75. Just to note, that doesn't mean that will be your mortgage rate. That is the rate that the banks are going to charge themselves when they lend money to themselves. And so that way, one way or the other, if the rate is higher, it will trickle down to you, the consumer. It will trickle down to the lending funds that you get, whether it's from the credit cards that you get, or even from the mortgages. It doesn't have a direct impact on it, but it sort of has an indirect impact on it. If you want to find out what the current market rates are for mortgages, this is the page that you need to go to, and it's Mortgage News Daily. This is updated in real time, and this is the site that all lenders and mortgage brokers use to determine what rate it's setting at the market. Now, one point to highlight is that whatever rate you see here doesn't mean that's the exact rate you're gonna get. This is an average, is meant to be used as a benchmark. It's an average nationwide of all the people who have applied and got a loan in these different categories. So let's say, for example, if you're applying for a 30-year fixed mortgage and it's currently sitting at 6.30, that means you could get a 6.3, but you can also go slightly lower if you have great credit and you are able to buy down points, or you can go slightly higher if your credit profile is not as promising as you would like it to be. The whole point of knowing this is so that you have an idea of where the rates are sitting, but this doesn't necessarily dictate the exact rate that you will be getting. Okay, now back to this article. And then, okay, so we're just going to move along here. The 9-3 vote against, again, feature hawking and dovish dissents. Governor Stephen Miran favor a steeper half-point reduction. That would have been nice, but I think that would have triggered inflation, but who knows? I'm not the one in the Fed. And so let's see, this is what I wanted to show. I don't care so much about like the he said, she said kind of situation. I care more about this, right? So this is just to give you an idea of what the rates have been, looking like for the past couple of years. So for those who were paying attention around in the 2000s, it was originally sitting at 6.5. And I said originally because this is as far as the chart to go for the last 20 years. But in context, if you were to compare this to the 80s and the 90s, back then there were double-digit rates. So right now we're starting up with a 6%, and then that's when the dot-com recession hit, and you see the rates going down, and they were at a low, but not an all-time low. And then eventually the Great Recession came, and I'm sure a lot of you remember the 2007-8/9 crisis, where the rates were cut to nearly zero, and it lasted for a good couple of years, as you can see. And then eventually they went down, but then the pandemic came and they lowered the rates again. And that's when, that's kind of like the most recent phenomenon that we all experienced, and where a lot of people were bidding for houses, driving the cost of the houses up, even though money was cheap, but now people were getting outbid for in their offers. And so right now we're sitting somewhere here, not at the highest point, but also not at the the lowest, but definitely a nice break if you, again, were in the sidelines looking to buy your primary residence at a more affordable price. And by price, I mean the rate. And those who are waiting on the sidelines like us, waiting to refinance, this is definitely a nice break. We're currently in the middle of a refinancing of our latest project, the acquisition that we made for $2 million. We actually closed it with the highest rate. We got a rate of 7.62, but it was still cash flowing. So we didn't want to let that deal go. We grabbed it and we figure eventually when the rates cool down, we can always refinance. And now we are, and we're being offered 1% less, which that in essence translates to an additional $776 back into our pocket. But with this piece of news, since we haven't locked the rate, that means we have the potential to go down even further. And I think we might be able to hit $1,100 back in savings, which also translate to cash flow, which all great news. And hopefully it's the same for you. Let me see what else. There was something else I wanted to highlight here. The stocks, they rose following the decision, with the Dow Jones Industrial Average adding 500 points, and Treasury yields move mostly lower, which once again, there's a kind of the Treasury years, especially like the 10 years and the mortgage rates, they move in a tangent. If you truly want to know what the rates are going to look like and the direction that they're going to go, pay attention to the 10-year treasury. Now, I want to move on into this article right here really quick. This is more of a reaction article, so to speak. It's more of a commentary, in my opinion. I don't necessarily agree with everything the author is saying. However, I find it interesting and it's worth a discussion here with all of you today. So this article is from CNN. The one that I read out before was from CNBC. So the CNN article, it talks about whenever it wants to update, my computer froze. Sorry about that. But eventually when it does fly in. Okay. All right. So here we have it. All right, so the Fed cut interest rates for the 6th time in a row. Here's why you're not seeing much of the difference in your loans, right? They talk about your savings, they talk about CDs and treasuries and municipal bonds. I don't care about any of that stuff. You're more than welcome to read this article at your own time. I do want to go down to the debt, because this year has been quite an interesting year in the sense that there had been a lot of ups and downs, and even like me personally, I've gotten a few instances where one tenant in particular, not some, so far has been one, and where there are a couple and their partner lost their jobs, and so this tenant has been paying still every month, but they have been paying late. So, and then in conversations, we found out that it was because now they're relying solely on one income. And that means that, hey, if they're late in their rental payments, that means they're probably stacking up debt on their credit card to try to stay afloat with everything else, right? And so this topic, it's very interesting because the rate cut decision does impact the credit card rates, the interest rates on your credit card, and it could impact how fast you actually pay off your debt. The higher the rates, the more difficult it is for you to get out of debt, right? So that's why I wanted to highlight this. So according to this, the author, what she's saying is that the fact that many consumer rates haven't fallen as much as the Fed funds rate since September 2024 isn't great news if you're taking on debt. So according to what we see here, the average rate on a credit card has fallen to 19.83 as of last week, down a percentage point from the 20.78% average in mid-September 2024. Any cut rates can save you money, but with rates so high already, the cuts won't be enough to make your debt truly affordable. I don't necessarily agree with that. Yes, I agree. I mean, these are credit cards we're talking about. They're usually in the double digit. I haven't met a single person that has a credit card rate at the lowest rate. In fact, one of my credit cards were at the 18% rate. And I recently got a letter from the bank saying that, oh, my rates are actually lower than the average. So they're just going to increase it for no reason, even though I have great credit and everything. Sometimes the banks, they just want to change the rules and take it or leave it, right? And so if you are in a position in where, like my tenant, that it's paying rent late, chances are again that you are depending highly on those credit cards to just stay afloat and just to keep covering your needs. And so when you're in that position, any minor discount that you get on your rate makes a big difference in how fast you finish paying it off. And if you are a business owner whose loans usually are on the 5 or 6 digits, that slight rate cut makes a big difference on your interest rates when you add all of the interest that you have paid today so far. So I don't necessarily agree with it. I'm thinking maybe she's coming from a point of view that, hey, well, if you have a low debt or someone who typically pays their card in a way that it's easily affordable for them, that's great. But I don't necessarily agree. Any minor discount, anything makes a big difference. And if you bring it up to a mortgage, we're talking about compounding interest, so it does make a big impact on your wallet. Home loans, right? So while mortgages rates have moved up and down in the past 15 months, as of last week, the average rate on a 30-year fixed rate mortgage was 6.19%, which is nearly identical to the 6.20 registered in mid-September. I agree with that. That's why I wanted to show you the rate. Even though we're currently experiencing a decrease in interest rates, it is not at its lowest point, and in fact, we are kind of like matching a certain point at a year prior. If rates continue to go down, well, great and excellent for those who are scheduled to refinance next year. But the truth is, you don't know what could happen next year. And if you can refinance today and your income allows you to qualify for that refinance, you should go for it now and not wait. Mortgages are primarily influenced by long-term interest rate dynamics, which are shaped by the fiscal outlook and the 10-year U.S. Treasury yield rather than just the Fed short-term policy rate. I agree. The Fed doesn't directly determine it, but once again, it does dictate how much the banks could charge one another. So in a way, that pricing gets trickled down to the consumer at the end of the day. So yeah, it doesn't influence it, but it's sort of like it still does a little bit, not so much. Now, given the expectation for a weakening job market, it is a possibility of a slower economy growth. Analysts expect those factors to push investors towards safer assets like the U.S. Treasury, reducing long-term yields. Because the more people want to buy something, I don't necessarily agree with it. I mean, in my analogy is that if the more people want to go buy treasuries, that will just increase the price of the treasury, not necessarily the yield. But maybe there's something I don't know. If there's something that you know that I don't, please leave it in the comment section to just partake in this conversation and at your 2 cents. So their prediction: the average 30-year fixed mortgage rate could fall to the upper 5% range by the end of next year. So that is excellent for those who are still waiting on the sidelines. But remember, everything has its pros and cons. Let's just put it that way. The rates could fall down to 5%, and that could be great for you if you're looking to refinance by then. Or buy your house for the first time. But remember, there's also other people waiting on the sidelines for the rates to go down. And right now, we are currently going through this phenomenon and where we have 2 generations waiting to buy. There's the generation of the millennials, people in their mid-30s and early 40s that are waiting to buy, who were outbid during the pandemic, or that maybe when they were ready to buy, the rates were quite too high and they couldn't afford to buy it anymore. And then there's a younger generation, the Gen Zs, who are now out of college and have jobs and they're ready to enter the home buying market. So when you combine these two, that means there are more buyers, and builders are not necessarily building more houses. They sort of like stop building since last year because they realized that there hasn't been much of a movement in the market. In fact, they have been given a lot of incentives for buyers to take advantage of deals, to lower interest rate points and stuff like that. And so unless the builders resume their building activity, chances are the lower the rates go, the more people are going to try to enter the market, restarting the bidding war. I don't foresee the bidding wars to get to the point that it got to during the pandemic, but I do anticipate some type of bidding war in some markets. So it's good to be on the lookout for that, and to just, be prepared and know what you're dealing with. One area of home debt where rates have dropped noticeably, it's on variable rate home equity lines of credit, the famous HELOCs, right? For those who are brand new to this, HELOC, it stands for home equity line of credit, and it's basically, it works like a credit card, with the exception that you don't get a credit card. What you get, it's a line of credit, and based on the equity that you have in your house, and you use based on what you need, and you will only pay interest based on what you need, and the interest rate is variable. Some people are afraid of it because of the whole variable interest, but I mean, it's a two-way street. Yes, I guess it's more of like knowing when exactly to use it. Like, for example, if let's say you took out a loan earlier this year because of an emergency on your HELOC because you needed to, you had no choice, you couldn't really choose. Right now, the fact that the Fed decided to lower the rates, that's good news for you because the HELOC will adjust to reflect that lower rate. And so I think it's more of a matter of a subject of knowing exactly when to use it. Like, we are currently with a business line of credit in one of our businesses, and because of an opportunity that presented itself, we just needed to take out money out of that business line of credit. We there was no way not to. Like, the business deal was too good to let go. And yes, we were paying the highest rate possible in the market, and we're still continuing to pay down that debt with the income that we're generating from that business that we bought. But the beauty is that now that the rates are cooling and the rates, the interest that we're paying, it's looking a lot nicer. And we haven't changed the amount of money we pay towards that line of credit. Like, we made a fixed payment every month, and now we're actually paying it off a lot faster than before because the rates have gone down. Now, if you're in the market for an auto loan, how does that impact you? Well, according to what we see here, average auto loan rates for new and used cars have only come down about a half percentage point since September 24, far less than the drop in the Fed's funds rate. Two primary reasons might explain why, according to the Consumer Insights analyst. First, there has not been a one-to-one correlation between the Fed's moves and car loans. I don't necessarily agree because, once again, who is financing those car loans at the end of the day? It is a bank, it is a lender. So if the banks are lending money between themselves, they do charge a certain rate, which eventually it does trickle down to you as a consumer. So maybe there's not a direct correlation, but there is an indirect correlation. It's the cost of money, and somebody has to pay it, and eventually it's always the consumer, the end consumer, the ones that ends up paying it. Kind of like the tariffs kind of thing, right? Like, everything goes up because we have to pay for it. Like, businesses can only do so much in terms of absorbing the cost, right? The business needs to survive as well. So eventually businesses are forced to increase their prices no matter what. Now, second, the best promotional rates are typically offered for loans that don't exceed 60 months, but the average line, I don't necessarily agree with what they're saying, but hey, it's good to know that that's their thinking and that we are prepared for that. So there you have it. The Fed lowers the rate an additional 0.25. That's all great news. Funny enough, before the announcement, this was all red. This was painful to look at, especially for us, which were refinancing on a jumbo loan because our loan is over $1 million. This was on the red zone. And then when the Fed made the announcement, it still hasn't changed. It was still in the red, but luckily 1 hour later, the market reacted well and positively. And the rates now, at least most of them are closing on the green side. And are coming down, and I hope that they continue to come down for the next couple of days, so that way when we lock the rates, we can actually get a great offer. And same thing goes for you. Now I'm going to open up the floor to see if anybody has questions or any contributions or any addition, and we'll just take it from there. So Jesus Girla, hi, nice to see you. Anthony, that's the co-founder. Hey Anthony, nice to see you. Prince Diamond down 49.50. Awesome, thank you for sharing. And then hashtag Trump the GOAT. So we got some Trump supporters here. New Fed chairman soon. Yes, that's what they are going to say. We have Raul. It's just a personal opinion. We at Novarize, I have to say, we try to stay off politics. We just, we try to stay as neutral as possible. We share the facts, but this is an open forum, and everyone it's welcome to come and share their opinions, as long as we are respectful to each other. So I'm listening. Salute. Okay. Thank you all for tuning in. It's great to be tuning into these lives and be able to connect with everyone. Any additional contributions that you guys want to make about the article of the rates or the economy, or any updates and any investment projects that you're doing, feel free to share, and I'm more than happy to broadcast it over here. Otherwise, thank you for tuning in, and I will give you your time back. This video, it's actually recorded, so you are more than welcome to watch the replay as often as you need. And I think that will be it. I don't see anyone tuning in, so I think that's as far as we go. Thank you so much for everyone else who's tuning in. In Instagram, I have Isabel, I have Clara, Ravi, Mav, Angel, Dania. Thank you so much. And I guess I'll be seeing you guys next. Take care. Bye-bye.